Hello everyone, Steve Lentz here with our Monday presentation from the Mentor Series. I'm with Discover Options, and we are the educational arm of OptionVue Systems. OptionVue's been in business since 1983, and at Discover Options we've been around, oh gosh, going on 6 years now, something like that. We got in the mentoring business years before that though, back in probably I want to say 2003, 2004. And it's been a great, been a great experience this whole time. What we like to do on Mondays is kind of give you a little bit of a taste of what our mentors are like. And of course, I do a session, and then the next Monday it might be Steve Papali or Frank Fahey or Paul Forcioni. All of us are with Discover Options and mentors here. But what I'm going to do today is just a slice of what you could experience from our inside wires. Now, what is an inside wire? Inside Wire is the name of the show that I do every Wednesday for our mentoring, every Tuesday morning at 11. Wednesday is the morning market huddle. Tuesday morning at 11 Central, I get together with as many of our students as can make it live that are in level 3 at least in our program, and I go over a different topic. Every week is different. Every month I go over the core strategies from level 3 to tell you how they did that month. And then intermittently, for the rest of the time on Tuesday mornings, I go over a different topic. And one topic I covered recently was just explaining an indicator that's kind of taking fire a little bit. I mean, more and more people are using it. It's called the DMI Stochastic. And what I did in that Inside Wire was I just laid this out and explain it. And so this is going to be really part 1, I guess. And then later when I go to part 2, I'm going to not only just, I'm going to cover the indicator, but then we're going to actually take it to the next level and test an options trading approach with that indicator. Today is part 1. We're only going to cover the mechanics of the DMI Stochastic indicator. All right. The actual option trading system will be rolled out in part 2, and I'll try and get to that either the next time I talk or the time after. We're getting a system together with this indicator. But today, it's just the indicator itself, okay? And just the mechanics of it. All righty. So let's, without further ado, let's get going here. This comes to us from an article by Barbara Starr in Stocks and Commodities magazine. And you can go to traders.com, put in DMI Stochastic. It came out, I want to say, about 3 months ago, something like that. Of course, I wish I had the exact article there for you. But let's see if the next one has it. Yeah, there it is, January 2013. January 2013 is when that article came out by Barbara Starr. And, you know, you could go to the, there's a segment of each issue where you can get the coding for different software programs that have charting in them, like Metastock, for example. And this is what I want to point out to you now. If you like this kind of thing, and if this indicator kind of, you know, makes you take notice and say, gosh, this is something I really need to play around with, what I want you to do is this. I want you to go to I think you just go and go to metastock.com/OptionVue. You could get a free trial of Metastock. And this is a charting software program that allows you to customize indicators, build your own indicators. And if you can program an Excel spreadsheet, you know, you should be able to easily learn the Metastock language. I find there to be a degree of similarities there, that if you can put a function into an Excel spreadsheet, then you can manage to do the Metastock language and programming specific indicators. Okay, so keep that in mind. You can just go to metastock.com/OptionVue, and there'll be a little promo code for you to type in and get your trial of Metastock. And you can, you know, start going to town and doing this kind of thing, all right? All right, so technical analysis typically involves 4 things that I'm going to show you the outline on what we're going to cover here today. But generally, in the world of technical analysis, you have to come up with some kind of a combination that fills in these 4 categories. First of all, some kind of a statistical indication as to which way the trend is, up or down, bullish or bearish. Then in many different technical analysis programs, there's a methodology for determining a trend pullback. That kind of gives you a pause in the action, and now you're ready to jump in the direction of that long-term trend. Then there needs to be a rule for an entry trigger for you to get into a trade, and then, of course, a rule that gives you a stop. Okay? And let's see here. There we go. So what we're going to do is show you, and so today we're going to cover these two things right here, the trend condition and the pullback. Part 2 of this, when we get into an actual trading system, is when we'll cover the next two, okay? All right, so here's the outline. We're going to talk about what is DMI. We're going to create a DMI oscillator to, well, there it is, determine trend. Okay, and that covers the DMI part of the whole thing. Remember, DMI Stochastics. Then we have to cover the stochastics part of this, and we're going to combine this to create a DMI stochastic to determine the pullbacks. And there's that first. There's number 1 and number 2 of the 4 conditions that we need to meet in the world of technical analysis. Then we're going to actually, I'm going to show you specifically what the signals are generated by this indicator. Okie dokie. Now, you're going to have to track with me, and of course, we're going to, you know, I think Jim will archive this if you need to go back and watch it, and you can put it on pause and all that and make sure you get this. But we're going to use Metastock the whole time here, and of course, with part 2, when we test an options trading approach with this, well, then we'll get into OptionVue's backtrader tool. All right, here we go. What is the DMI, Directional Movement Indicator? Directional Movement Indicator, DMI. All right, this was developed by Wells Wilder back in the 1970s when he wrote this book, New Concepts in Technical Trading Systems. In that same book, he came out with RSI. He came out with Average True Range, ADX, DMI, and you know, I mean, he threw out there a bunch of stuff that's used today and by default in a lot of different charting programs, all in one book. He did it without computers. All of his concepts were done with by hand and elaborate spreadsheets and everything. It's quite a foundational work in the world of technical analysis. So we're kind of going straight to the source to get this. DMI. When you dial it up in your charting program, such as in Metastock, typically you're going to have 3 wavy lines down in that window underneath the actual chart. All right, so you have typically a red line, a green line, and a black line. The black line is labeled the ADX, and you know what? We're not going to deal with that right today. See, I'm kind of taking it out. I click the button and boop, it disappears. Okay, we're not going to approach the ADX at all. Now, I know there's a lot of ADX aficionados out there, whole systems based on the ADX itself, the slope of it, this and that. For our purposes, we're not going to use that. All right, we are focusing in on the directional, the directional movement to the upside and the downside, the bullish and the bearish directional indicators, the red line and the green. Green being bullish, red being bearish. Now, I'm going to show you mathematically how we get these lines and what's going on behind them. And it's very interesting because in the world of technical analysis, quite often we use moving averages to determine trend. You know, MACD, you know, so many will use some kind of a moving average, you know, price envelopes, Bollinger Bands. They all start with moving averages. In the world of the DMI, we're throwing out the moving average concept completely, and instead we're looking at each bar as its own separate adventure. And what does it measure? Okay, what we're looking for is look at this in writing here. The largest part of the current trading range that is outside the previous trading range. So let's dissect the sentence. The largest part of the current trading range that would be, let's just go to this first bar on the left, okay? The current trading range, all right, second bar on the left, that is the largest part that is outside the previous trading range. Okay, so let's go to that one on the far left there. And you could see that on the bearish side, we had a segment of the bar that was outside the previous trading range. On the top side, we have a much larger region or portion that is outside the previous trading range. And so that's the one we're focusing on. That is the directional movement for that bar, because that's the largest part of this trading range that lies outside the previous trading range. And so that green one, that would be a positive, there would be a positive directional movement there. Okay, let's keep going. Let's go to the next bar here. The largest part that lies outside. Well, there's nothing to the downside that lies, so it's to the upside only. Positive directional. Okay, the next bar, this portion here is larger than the smaller portion that was outside there, so we only look at the positive. This next one, there is nothing up above, but here's the small portion that lies outside the previous range, and on we go. See that? So no moving averages now. We're looking at each bar's portion that is outside the previous day's range. So how do we determine this? All right. We take the largest portion, like I just did. Here's 5 and here's 1. And what we do is we start keeping track of this in the plus directional movement, the bullish, and then the bearish. So in this case, it was 5 points outside the previous. So we give the plus directional movement ledger a +5. The minus, even though it was 1 point, we don't even count it. We just ascribe that day as having 0. Then we go to the next day. See that? Nothing on the bullish side. We go to the bearish side and we see that there was 6 points. So the negative directional is ascribed a value of 6. The plus has a value of 0. Okay, and we keep going and we look at every bar. And by default, we go back 14 bars. I think for our purposes, we're going to go back about 10 in the way that we did this. And then later I'll show you, what values we use. But what you do is basically take each bar segment and you start creating a ledger here. See that? A ledger. And it's not enough. Okay, it's not enough that we have this ledger for the plus and this ledger for the minus, okay, because 10 could be big or small, but it's relative to the average range of the bars. And so we're going to normalize this, right? We're going to normalize this to the typical day's range. We're not just going to take the sum of these versus the sum of the negatives. We have to normalize it for the average true range. Now, this is another thing that Wilder came out with, was the day's true range, he called it. What is the true range of a given bar? Okay, now, it could be, number one, high minus the low. That could just be here minus here. Okay, or, and that's the largest of these three definitions, today's high minus yesterday's close. Okay, today's high minus yesterday's close. Okay, now let me see here. What do I click? Day one is 30 points. That's the high minus the low. Then the next one is yesterday's close minus today's low. And the reason we have that is so that we can account for gaps. Okay, we're accounting for, now we're using this day's range to normalize this. And so here's the formula here. Okay, what's the positive directional indicator? We take the 14-day weighted moving average, okay, of the pluses, plus DM, divided by the 14-day weighted moving average of the true range. And that gives us the green line value. let me change that. Here, let's get the green. Green. That gives us the green line value here. Then we go to the red line. The 14-day weighted moving average of the minus values divided by the 14-day weighted moving average of the true range. This gives us the red line. So when you put this together, you have then, in the window below, you have a red line and a green line. And generally, when the market is going down, you're going to have a situation where the red line is above the green. When the market's going up, you have an uptrend, and the green line is above the red. Here we have a downtrend, and that's when we see that the red line is above the green. See that? Okay, so in the world of DMI, typically what is the trading signal here? Let me click. Okay, now I'm not going to go into the signals on the DMI trading system, okay? I should have deleted this. Sorry, I didn't. Okay, but we're not going to get into that. That's a whole nother, boy, I should have done that. Sorry about that. We don't want to look at trading signals based upon these lines themselves. Instead, what we're going to do is take this green line and red line that you see here, and we're going to create an oscillator. Now, what is an oscillator? Okay, we're going to take the green line minus the red. Here we go, green line, okay, minus the red, all right, equals our oscillator. I could just put Oscar. All right, so watch this. Here we go. Here's the oscillator here. Here's the green line and the red line together, the directional, that's the DMI. That's the DMI. Now watch this. Let's go to the left, over here on the left. When the red line is way above the green, okay, green line minus the red, we're going to have that red line, we're going to have the oscillator quite, on the negative side. When the green line becomes higher than the red, green line minus the red, then we have positive values. See that? Here's a segment here where the green line is above the red, therefore we have positive values. And when the green and the red really separate a lot, that's when we have a nice big mountain peak right there. See that? Okay, so this is our DMI oscillator. Okay, now, and then what's going on here in 2003 in January when I put all this together? Look at this. The green line is way above the red, big uptrend going on, and then we had a big positive value here going on. I mean, this was very much in the positives. All right, so that's the oscillator. Now, what we like to do, and you can do this easily in software like Metastock, is that you can create, a little expert here, so that when you have positive values here, you have the bars painted in blue, meaning bullish. When you have negative values in the oscillator, well, that's when you could paint the bars red. Therefore, every bar is either red or blue, bullish or bearish, just depending on if the DMI oscillator is positive or negative. And that kind of helps us out with the long-term trend, right? That's the long-term trend, as if it's up or down, positive or negative. That's kind of showing us what the long-term trend is in this case. And so this is our long-term trend indicator, is whether we have a positive oscillator or a negative oscillator value. All right, now, we're going to take that concept of the DMI oscillator, and I want you to kind of just put it on the shelf. We're going to come back and get it in just a second, because what we're going to do now is go and look at stochastics. Remember, the whole presentation is on DMI stochastics. I showed you what the DMI oscillator is. Now we have to go learn stochastics. See, you're getting 2 in 1 here. 2 indicators for the price of 1. Let's see. Robin is saying that there's a new version of Metastock which is a bit different from earlier versions. Yeah, Robin, I know that. I think that's from a data perspective, and I know that they have some fundamentals thrown in as well. I'm using the portion of Metastock pertaining to technical analysis, but you're right, Metastock came out with this new, there's a version of it that really brings in a lot of fundamental analysis. And it even, what you can do is you can put technical analysis studies on fundamental data. It gets kind of, you know, you can really go deep with this stuff. If you have earnings trend, you can use technical analysis on the earnings data, for example, and try and ascertain a trend there. It's pretty cool. All right, so here we go with stochastics. Okay, DMI on the shelf, coming out with stochastics here. What are stochastics? And I put, you know, I'm almost embarrassed to use Wikipedia, but you know what? Sometimes Wikipedia nails it. I mean, they articulate definitions pretty well sometimes. And so when I see it, hey, I'm going to give credit where credit's due. Stochastic oscillator is a momentum indicator used in technical analysis, introduced by George Lane in the 1950s to compare the closing. Here's the important part. Let me get my little yellow highlighter. It compares the closing price of an asset to its price range over a given time span. That's the best concise description of stochastics that I've ever seen, is that we're comparing the current value of an asset, stock, index, future, whatever. We're comparing the closing price, the current value, to its price range, the range of prices over a given time span. All right. Now, we're going to show you that in a second, but in a nutshell, stochastics are, this is just an awesome indicator because it's very flexible. You can use it for trend confirmation, divergence, determining pullbacks, overbought, oversold levels. It's quite a flexible indicator once you get going with it. And so it's something that I think it's easy to conceive and understand, and it's very flexible. So let's go into this a second here. When you look at a stochastics window, you're looking at two lines typically, and George Lane labeled these %K and D. I don't know why it's labeled K or D. He could have picked, you know, chosen any letter, I suppose. But in any case, D comes later. We're going to focus on K right now. Okay? Okay. Here's the formula. Close minus the low over a given period number of days. That value is divided by the high over a certain period of days minus the low over a certain number of days. That's the range times 100. Okay, so let's just get this in a concrete sense here. Here we go. Close minus the low over a certain number of days, and by default, stochastics is 14 days. You have to go in and change the setting typically in your software program. But if we were to look at the low over the past n number of days, okay, where would we be? I think we're going to be about right. Okay, compare the closing price of an asset to its price range. There it is. Here's the low over 14 days. Here's the high over 14 days. And on the right here, you can see the current value, the closing price. So when you plug these values in, what are you going to get? Okay, when you plug those values in, here's what you're getting. And what it's showing us, again, and I want to just kind of go back up here for those of you real new to stochastics, compare the closing price of an asset right here to its price range over a given time span, here to here. It's very close to the bottom of its price range over the last 14 days. Do you see that? The current value is very close to its all-time low over the last 14 days, the 14-day low. When you run this through, what you're going to get is a value between 0 and 100. And that's what all stochastics show you, is a value between 0 and 100. And in this case, when you crunch the numbers, we're at 1.50. Really, really low relative, you know, to the price range there. So it's not at 0, meaning that it's at its 14-day low. We're a little bit above our 14-day low. At a 1.5 out of a scale of 0 to 100, we're at a 1.5, very, very low. All right, let's go to the next one. Let's go to another example. Here we go. Let me just ask you, where would percent K be now? Would it be above 50 or below? You don't have to just answer to yourself. When we crunch these numbers, do you think the stochastic value, percent K, is going to be above 50 or below 50? Just kind of guess for yourself. And then let's crunch these numbers here. The highest high for 14 days, the lowest low for 14 days. Here's the low, here's the high, here's where we are now. What's the value of K going to be? Well, the current price is very, very close to its 14-day high. So it's going to be above 50. It's probably going to be above 90 when there it is. When you crunch the numbers here, we're at a 94.29 up there. Okay, we're always between 0 and 100, and we're way up there now when you crunch the numbers. Very good, all right? So I think you're getting the hang of it. Now, when we crunch these numbers, we always call this, by default, the fast stochastic. The fast stochastic. And when you crunch the number for every single one of these bars, you get this choppy line here. This is percent K. And what we like to do quite often is, because it's just too choppy, is we really think about smoothing that percent K, in which case we call it a slow stochastic. It is still percent K. It's just that in this case we're taking a 3-day average of the choppy and smoothing it out a little bit, and that's what it looks like. So this is a 14-day slow stochastic, slowed by 3 days. And let me flip-flop back. Let me go back to the fast, slow. See that? Look at the peak right here, how much smoother that is. So this is fast, and this is slow. Okay? We're still at percent K. All right? Now, and typically we always slow it. Very seldom do you see just a straight fast stochastic. Most technicians like to slow their stochastic down at least a little bit, smoothing it out a little bit, okay? Now, what comes next is called percent D. This is simply a simple moving average of percent K. It's also called a trigger line here. So if we take the smoothed percent K, what we're going to do is take a moving average of this line. We're going to paint it red and make it dashed instead of solid, and that will be our trigger line that you see right here. It's a 3-day average of the slowed percent K. You see that? And typically in the world of stochastics, you have crossovers here that are, that can be real good trading signals. And you know what? In choppy markets, these crossovers can be very reliable signals when you're in a non-trending market. In fact, they could be phenomenal signals at times when you're in a non-trending, choppy market. The price just keeps oscillating up and down in a range, and this stochastic can become very predictive when you are in a market like that. But this is the world of stochastics. Now, if you go into OptionVue like you see here, or any other charting program, typically you got your percent K parameters, the slowing effect, and then your percent D. And we always write that out, what the settings are. There's 3 digits. This is a 1433. 1433. Okay? Sometimes people don't like any percent D at all, in which case they would just say a 14.3, and that would just give us this right here, just this one line. Okie dokie. All right. And I just wanted to point out, in the world of stochastics, you can kind of go crazy with these settings. And the settings could be, real good trend determinant, or just indicators here. When you have the crossovers, they can kind of confirm that there's a trend going on. Here's a crossover here that kind of brought in this right there. I mean, it can work really well. It can work really well, and this is why it's one of the most used and reliable indicators out there. Overbought, oversold, divergence, you know, pullbacks to very, very high utility type indicator, and that's why we're going to use it here in the next portion here, okay? And here's how it goes. And let me take a little break, get a sip of rapidly, well, actually it's cold coffee by now. Just a second. All right. Now here's kind of the wild thought here is, let me back up here. Right here, we're using a stochastic indicator here that's looking to price. Okay, we're looking to price. And what we're proposing here, and this is what Barbara Starr brought to the table with her article introducing this whole thing, is that we're going to apply the stochastic concept to the DMI oscillator. Instead of looking at price, we're going to look at this DMI oscillator here as it goes up and down, and if it gets to an all-time, you know, 10-day high, well then we're going to have this little stochastic going on here that's giving us, you know, some signals. So what we're doing here is we're doing a 10-day look back for our %K. We're going to smooth it by 3 days. And in terms of a %D, let me make this very clear, %D, okay, we do not have it. We're not using %D. We're only looking at a slowed %K of the DMI oscillator. So watch this. Here's the DMI stochastic. This is the DMI stochastic. What we're doing is that when the DMI stochastic is high and ascending higher, and it's making its 10-day, you know, all-time, you know, highest highs for 10 days, you can see here that our stochastic, you know, up here is really pushing 100, between 90 and 100 when it gets into this all-time high range here. See that? And then when it starts going down, you can see that the stochastic smooth starts going down. And when it gets to all-time 10-day lows, well, that's when we're down there between 0 and 10. See? And so, you know, in the world of stochastics, usually anything above 90, 80, you know, that's considered overbought. Anything under 20, under 10, that's considered oversold. Okay, so we're kind of combining indicators. It gets kind of a little bit kind of crazy a little bit, I understand, but here's the concept here, and here's kind of a, okay, no, there's a, here we go. Here I go. I drew in the blue and the red. Okay, so when the DMI oscillator is positive, we're painted blue. That's our uptrend. Okay. When it's in a downtrend like this, it's painted red. What's my next screen here? Okay. Here are the signals. Here are the signals. Let's just go to these. Here are the signals that can happen. And then, of course, in part 2, I'm going to show you how we can trade options off of these signals and how well a certain system would work. But what are we going to, how are we going to take this information and turn it into actual tradable signals? Here's the notion. When you have an uptrend, let's go to the middle of the screen here. When the uptrend is blue bars, that means that our oscillator is positive. Okay. What we're going to do is wait for the pullback that occurs when the DMI stochastic comes down to 10 or less. Okay, and then bounces up above 10. So it has to go down below 10 and then up above 10. Below 10 and then up above 10. Below 10 and up above 10. Let me get a straight line here. So you can kind of see when this happens. I'm going to try and draw the signals. You can kind of see I program my Metastock to give me the arrows when this happens. All right, real good. Now here's one that happened. The bars were red, went down below 10 and above 10, but it was a red bar, so we wouldn't take that signal, right? We want to only take bullish signals when it's blue here, like right here, okay, where it came down below 10 and up 10, above 10, right there. Right there. See that? Perfect. All right, so that's the bullish signals. Let's go to the bearish signals. Bearish signals occur when the oscillator goes, when the DMI stochastic goes above 90 and then goes below 90. Above 90, below, above 90 and below, above 90 and below. And you want to take those bearish signals when the bars are red. When the bars are red, like where you see right here, okay, when above 90 and below. And what we're doing is we're getting pullbacks. The long-term trend is down. Okay, we have a negative oscillator, yet we have the stochastic coming up above 90 and curling under 90. That gives us a good signal right there. Okay, see how that works? So that is the signals off the extreme, and I hope I explained that clearly. Okay, once again, the trend is determined by the oscillator being positive or negative, painting the blue bars or the red bars. Then we want the pullback to happen. So we have this uptrend here, price pulls back, the DMI stochastic pulls back to under 10 and bounces up, and that gives us a good signal right there. See that? Okay, so that's called signals off the extreme. And in the world of my what I'm testing out for the options trading, these are the signals I really want to tee off on, is the long-term trend using the pullbacks that you see here, and then going back in the direction of that trend. But it has to pull back enough so that we have some extreme values. That's the key. That's what's key here. Okay, what are some? Oh, and here I combined them all. Here I combined them all, all in one. You can see the bullish and bearish arrows. You just have to make sure that they're filtered out. So you don't want to take bearish with the blue bar, okay? You want to take bullish with the blue bar like you see here, okay? Well, and here's one you would have been whipsawed a bit. But, you could see the bullish with the blue bars, have a much better chance of making out there. What contributes a bar to turn red from blue and blue to red? Okay, Robin. Once again, when the oscillator is bullish, the bars are blue. When the oscillator is negative, the bars are red. Okay? When the DMI oscillator is positive, the bars are blue. When they're negative, the bars are red. Okay, that's the long-term trend. Then we're just waiting for the signals off the extreme. Now, what else can you do? Well, you probably guessed it, those of you who are stochastics aficionados. In the world of stochastics, remember, we were missing that %D, weren't we? This was set up as a 10-3 %K. Now we're going to throw on a 3-day moving average to give us our signal line here, and that's what the red line is there. That's the 3-day moving average of that DMI stochastic. And you guessed it, when you have a crossover, well, then you have some signals going on like you see here. See that? And you can kind of look, and let me draw the line here. You have this, when you have the crossovers, boom, boom. I threw in a diamond. That's something you can do in Metastock, is use either up arrows, down arrows, diamonds of different colors. You can throw in numbers if you want. All kinds of fun little, I don't know, little pictures, I guess, you could throw on the screen to indicate various different types of signals. So this is kind of more like, now these aren't off the extremes, Okay, these are going to be at locations perhaps other than extremes, but if you like the crossover of the stochastic concept, you can certainly apply that here. And Barbara Starr in her article goes over this as well. Again, it's the January edition of Stocks and Commodities magazine, Technical Analysis of Stocks and Commodities. And of course, you can put all this together and get both types, and then you have diamonds and arrows and all kinds of fun stuff. But again, you only want to take signals in the direction of the long-term trend. So on the left, you would only take the bullish signals here. You would ignore the bearish signals. Then when the market is long-term trending down, you only take the bearish and ignore the bullish. Okie dokie. Here we have all bullish right here, so you would only look at the diamonds or the arrows going up. All in all, it has a lot of merit. Something completely different than just the straight moving averages and the MACDs and all that. It's coming at it from a different angle, and I like that about this. You're combining two different concepts. I think it has a lot of merit. And what we're going to do next time we get together is explore how to exploit some of these signals using option spreads. And I'm going to have back-tested studies to show you and all that fun stuff, okay? But that's it for today. Do you guys have any questions at all? This will be available in the archives, I believe. Jim does a great job of posting those. And, you know, I think it's next time we get together in about 3-4 weeks, we'll have some good stuff for you, okay? Okie dokie. Thanks, Brian. All right, folks. Thanks so much. We will see you next time, 3-4 weeks from now. Same time on a Monday, 1 o'clock Central. Take care. Enjoy the spring. Bye-bye.